some instant reaction to all of these stories. Joining us for the Canadian perspective here in studio is Desjardins, chief economist with Deloitte Canada. We're pleased to have her as always. And for the U.S. perspective, joining us, Kathryn Rooney Vera, chief market strategist at StoneX Group. Great to have both of you with us for this. Desjardins, I'm going to start with you in the Canadian story. What's your reaction to an unexpected contraction for Canada's economy?
I mean, as you say, it's weaker than expected. I think generally people were looking for a pretty significant slowing in the economy. I think the surprise was a bit of a contraction on the residential investment because we had seen that spring surge in sales. And so I think most of us were anticipating that we'd see positive on the housing situation, but that was weaker. And of course, the consumer pulling back a bit after some pretty robust gains as we started the year. So to your point, I think, we are seeing the Bank of Canada actually getting some traction here with those rate hikes.
Well, I want to get some perspective from Kathryn Rooney Vera as well, because this is an interesting morning where U.S. markets are watching the latest jobs data, and already it seems like there are some market participants who are making the case that this data set, coupled with other data sets recently, point to a cooling effect for the economy. The market now trying to price the possibility of Fed action going forward. But as Don was noting, we have a Bank of Canada decision next week, and it does seem to show that you're seeing those weakening effects already here in Canada. What are you watching when it comes to the U.S. economy by comparison?
Hi, John. Yeah, and it's interesting because bearish news out of Canada and really good news out of the U.S. today. At 8:30, we got that jobs data, and it's showing the rising chance of this soft landing. And the markets are loving it, John. The equity markets are up. We had the 2-year yield on U.S. Treasuries down, and the markets are excited about this data. It showed about, if I'm not mistaken, 110,000 downward revisions to the prior 2 months. We saw a cooling on wage growth to the slowest month-over-month pace since February of last year. All of that is welcome news because here in the U.S., the main driver of core PCE, which remains about double the Fed's target of 2%, is definitively service sector inflation. And service sector inflation is moved principally by wage growth and the red-hot labor market. As consumers here in the U.S., we have jobs, we're seeing wage growth that exceeds inflation, and we're still consuming, especially those services. So today's data is welcomed. Let's see if it continues. But so far, so good here in the U.S., and the Fed is loving this morning's non-farm payrolls and labor market data.
Well, this has been the tricky act for these central banks. And Desjardins, yep, back over to you. I mean, the data that we can now look at in front of us could arguably suggest that we're already in the middle of a technical recession in this country. We do have a Bank of Canada decision next week. Arguably, most of Bay Street felt that the bank at this point, at the very least, would stay on the sidelines. Does a data point like this cement that possibility? Well,
I don't think we can say cement, but certainly it does really support the idea that the bank can take a step back. We know that the inflation rate ticked higher, but when you look through other measures, yes, core sticky, but it's not rising. So I think it does really augur well for us forecasters who are looking for the bank to stay on the sidelines. Certainly, when we look at the handoff, that's a weak handoff to the third quarter. July looks like it was flattish, according to the preliminary estimates. So again, we're starting from a weak spot. So are these rate hikes getting traction? I think arguably, yes, they are. And it does give the Bank of Canada room, really, to just step back.
And I guess on this subject, Kathryn Rooney Vera, of fighting inflation, and I'm looking even at gold gaining. It's at a 1-month high right now in reaction to this jobs report in the United States today. The idea that wages are rising at a slower than forecasted rate right now. The fight against inflation has been part of this very strong narrative, whether it's Jay Powell or here in Canada, Tiff Macklem, like we don't want to end the fight before we're done. So how does the central bank indicate that maybe they're seeing signs of progress without wanting to send a message to the markets that we're entering some environment here where they're ready to, end the rate hiking cycle per se?
They're in a tricky spot, and here in the U.S. could happen what has happened in Canada, which is that the Fed has to, have this delicate balancing act. And if we get a reacceleration in inflation, which I think could very well happen here in the U.S., especially if the soft landing scenario manifests, meaning that the unemployment rate remains historically low, we still see economic growth, and inflation remains sticky above that 2% target, the Fed could very well have to hike again. It could happen. And that's not discounted in the market. The interesting thing here, and the Fed talked about this at Jackson Hole, John, is that no one really knows where R-star or the NAIRU are at this juncture. So it's hard for the Fed, I think, to know whether they've been restrictive enough or not, or too restrictive. So I think what they're looking at and what I'm looking at is private credit is finally contracting. And I think that's going to roll over into the U.S. consumer. I think the risk of recession is elevated. So the Fed is going to have to next year make a tough call. Either they maintain, a higher inflation rate implicitly, because I very, very much doubt that we get to 2% inflation in the soft landing scenario where you have a still robust consumer driven by consumption of services, miraculously continuing this disinflationary trend, corresponding with ongoing economic growth and 2% inflation. It's really hard to get there. So the Fed either is going to have to increase their target implicitly, not explicitly, or they're going to have to maintain the Fed funds rate at 525 or 550 for the entirety of next year, which is currently not discounted into the markets. So tough decisions coming up for the Fed going into next year.
All right. And Don Desjardins, just a final comment to you coming back to the Canadian economy. And I do want to point out that it was a complicated quarter for the economy just because we were dealing with wildfires, the BC port strike, and you did see, for example, contractions in crop production, oil extraction, mining related activities. So we have to factor that in. But just the simple reality that real household spending was slowing, and you've got rising wages and disposable income that isn't able to necessarily, I guess, pack the kind of punch you would expect, almost suggests as the psychology of this higher interest rate environment is taking hold.
Yeah, and the savings rate moved back up. It had come down significantly in the first quarter, and we did see Canadians putting a bit more aside. I think that's reasonable. We've seen deterioration in consumer confidence, so I think consumers are taking all of this on board. They know that the rate increases are, in fact, causing their disposable incomes to be put to paying their bills. Inflation is not right down, so I think there's a lot that Canadians are maybe pulling back a little bit to be more cautious.
All right.